Welcome to Vorldrevolution. Dear friends, today we will share summary and example from the book The Path, Accelerating Your Journey to Financial Freedom by Peter Mallouk and Tony Robbins. The Path is a comprehensive guide designed to help readers achieve financial freedom through practical strategies, tools, and a positive mindset. The book is structured into 5 main sections, each representing a stage in the journey towards financial independence. The journey ahead. The book begins with an optimistic outlook on the future, emphasizing that there has never been a better time to be an investor. This section sets the tone by highlighting the importance of a positive mindset and the potential for growth and opportunity in the current economic landscape. The authors argue that despite the challenges and uncertainties, the future holds immense promise for those who are prepared and proactive. Charting your path. In this section, Mallouk and Robbins delve into the fundamentals of financial planning. They discuss the importance of setting clear financial goals and creating a personalized roadmap to achieve them. This involves understanding your current financial situation, identifying your long-term objectives, and developing a strategy to bridge the gap. The authors also cover the pros and cons of working with financial advisors, estate planning, and the significance of having a well-thought-out plan. The trailhead. Here, the focus shifts to the practical aspects of investing. Mallouk and Robbins advocate for long-term investment in stocks, explaining how this approach can lead to substantial growth over time. They provide insights into market behavior, the importance of diversification, and how to maintain peace of mind during periods of volatility. This section is rich with examples and real-life success stories that illustrate the benefits of disciplined investing. The climb. As the journey progresses, this section addresses the management and adjustment of your investment portfolio. The authors discuss how to align your investments with your personal goals, risk tolerance, and changing circumstances. They emphasize the need for regular reviews and adjustments to ensure that your portfolio remains on track. This part of the book is particularly valuable for its practical advice on portfolio management and the importance of staying informed and adaptable. The summit. The final section of the book explores the concept of fulfillment beyond financial success. Robbins, known for his motivational insights, discusses the importance of finding happiness and purpose in life. He encourages readers to consider how they can give back and make a positive impact once they have achieved financial freedom. This section serves as a reminder that true success is not just about accumulating wealth but also about living a fulfilling and meaningful life. Examples from the book. Throughout the path, Mallouk and Robbins share numerous examples and anecdotes to illustrate their points. For instance, they recount the story of an investor who, despite initial setbacks, achieved significant financial success by adhering to a disciplined investment strategy. Another example highlights the pitfalls of emotional investing and how maintaining a long-term perspective can lead to better outcomes. One particularly compelling story is about a couple who, through careful planning and strategic investments, were able to retire early and pursue their passions. This example underscores the book's central message that financial freedom is attainable for anyone willing to follow the right path. The Path is a valuable resource for anyone looking to take control of their financial future. By combining practical advice with motivational insights, Mallouk and Robbins provide a clear and actionable roadmap to financial freedom. Whether you're just starting out or looking to refine your existing strategy, this book offers guidance and inspiration to help you achieve your financial goals. Here are key highlights the book. 1. Why the future is better than you think and why there is no greater time in history to be an investor. The Path presents a compelling argument for why the future is brighter than many might believe and why now is an unparalleled time to be an investor. This perspective is rooted in several key factors that they elaborate on throughout the book. Technological advancements. Mallouk and Robbins highlight the rapid pace of technological innovation as a primary driver of future prosperity. Technologies such as artificial intelligence, biotechnology, and renewable energy are not only transforming industries but also creating new opportunities for growth and investment. For instance, advancements in AI are revolutionizing sectors from healthcare to finance, leading to increased efficiency and new business models. This technological progress is expected to continue accelerating, offering investors unprecedented opportunities to capitalize on emerging trends. Globalization and market expansion. The authors also emphasize the benefits of globalization. As markets become more interconnected, companies have access to a larger customer base and more resources. This expansion leads to increased competition, innovation, and economic growth. For example, the rise of e-commerce platforms has enabled businesses to reach customers worldwide, driving sales and profitability. Investors can benefit from this global market expansion by diversifying their portfolios to include international stocks and emerging markets. Historical market resilience. Another critical point made in the book is the historical resilience of financial markets. Despite periodic downturns and crises, markets have consistently rebounded and grown over the long term. Maluk and Robbins provide examples of past market recoveries, such as the rebound after the 2008 financial crisis, to illustrate the importance of maintaining a long-term perspective. They argue that understanding this historical context can help investors stay calm and make informed decisions during periods of volatility. Increased access to information and tools. Today, investors have more access to information and tools than ever before. The internet and financial technology have democratized investing, making it easier for individuals to research, trade, and manage their portfolios. Maluk and Robbins discuss how platforms like robo-advisors and online brokerages have lowered the barriers to entry, allowing more people to participate in the stock market. This increased accessibility empowers investors to take control of their financial futures. Examples from the book. Throughout the path, the authors provide numerous examples to support their optimistic outlook. One notable example is the story of an investor who, despite initial setbacks, achieved significant financial success by adhering to a disciplined investment strategy. This story underscores the importance of staying the course and trusting in the long-term growth potential of the market. Another example involves a couple who, through careful planning and strategic investments, were able to retire early and pursue their passions. This case study highlights the transformative power of financial planning and the potential for achieving financial freedom through smart investing. Maluk and Robbins' message is clear: the future holds immense promise for those who are prepared to seize the opportunities it presents. By leveraging technological advancements, embracing globalization, understanding market resilience, and utilizing modern tools, investors can position themselves for success. The key is to maintain a positive mindset, stay informed, and make strategic decisions that align with long-term goals. 2. How to chart your personally tailored course for financial security. The Path provide a detailed guide on how to chart a personally tailored course for financial security. This process involves several key steps, each designed to help individuals create a customized financial plan that aligns with their unique goals, circumstances, and risk tolerance. Understanding your current financial situation. The first step in charting your course is to thoroughly understand your current financial situation. This involves taking stock of your assets, liabilities, income, and expenses. Maluk and Robbins emphasize the importance of creating a detailed financial statement that provides a clear picture of where you stand financially. This foundational step is crucial because it allows you to identify areas where you can improve and set realistic goals. Setting clear financial goals. Once you have a clear understanding of your current financial situation, the next step is to set specific, measurable, achievable, relevant, and time-bound, SMART, financial goals. These goals should cover both short-term and long-term objectives. For example, short-term goals might include building an emergency fund or paying off high-interest debt, while long-term goals could involve saving for retirement or purchasing a home. Maluk and Robbins stress that having clear goals helps to provide direction and motivation. Developing a personalized investment strategy. With your goals in place, the next step is to develop a personalized investment strategy. This involves determining your risk tolerance, time horizon, and investment preferences. Maluk and Robbins advocate for a diversified portfolio that includes a mix of asset classes such as stocks, bonds, and real estate. They explain that diversification helps to spread risk and increase the potential for returns. Additionally, they recommend regular portfolio reviews and adjustments to ensure that your investments remain aligned with your goals and market conditions. Creating a financial plan. A comprehensive financial plan goes beyond just investments. It includes budgeting, tax planning, insurance, and estate planning. Maluk and Robbins highlight the importance of having a holistic approach to financial planning. For instance, they discuss the benefits of tax-efficient investing and the need for adequate insurance coverage to protect against unforeseen events. Estate planning is also crucial to ensure that your assets are distributed according to your wishes. Monitoring and adjusting your plan. Financial planning is not a one-time event but an ongoing process. Maluk and Robbins emphasize the importance of regularly monitoring your financial plan and making adjustments as needed. This could involve rebalancing your portfolio, updating your goals, or revising your budget. They also recommend working with a trusted financial advisor who can provide guidance and help you stay on track. Real-life examples from the book. Throughout the path, Maluk and Robbins share real-life examples to illustrate their points. One such example is the story of a young couple who started their financial journey with significant student loan debt. By following a disciplined financial plan, they were able to pay off their debt, build an emergency fund, and start investing for their future. This example highlights the importance of setting clear goals and sticking to a plan. Another example involves an individual who was nearing retirement but had not saved enough to maintain their desired lifestyle. By working with a financial advisor, they were able to develop a strategy that included downsizing their home, maximizing their retirement contributions, and adjusting their investment portfolio. This story underscores the value of personalized financial planning and the need to make adjustments based on changing circumstances. Charting a personally tailored course for financial security involves understanding your current financial situation, setting clear goals, developing a personalized investment strategy, creating a comprehensive financial plan, and regularly monitoring and adjusting your plan. By following these steps, as outlined by Maluk and Robbins, you can take control of your financial future and work towards achieving financial freedom. 3. How markets behave and how to achieve peace of mind during volatility. The path delve into the behavior of financial markets and how investors can achieve peace of mind during periods of volatility. This topic is crucial for anyone looking to build and maintain a successful investment strategy. Understanding market behavior. Maluk and Robbins explain that financial markets are inherently volatile, characterized by fluctuations in asset prices due to various factors such as economic data, geopolitical events, and investor sentiment. They emphasize that while short-term market movements can be unpredictable and sometimes alarming, the long-term trend of the market has historically been upward. Historical context. The authors provide historical context to illustrate how markets have behaved over time. For example, they discuss the Great Depression, the dot-com bubble, and the 2008 financial crisis. Despite these significant downturns, markets have always recovered and continued to grow. This historical resilience underscores the importance of maintaining a long-term perspective and not making impulsive decisions based on short-term market movements. Achieving peace of mind during volatility. To achieve peace of mind during market volatility, Maluk and Robbins offer several strategies. Diversification. One of the key strategies they advocate is diversification. By spreading investments across different asset classes, sectors, and geographic regions, investors can reduce the impact of any single investment's poor performance on their overall portfolio. This approach helps to mitigate risk and smooth out returns over time. Staying informed and educated. The authors stress the importance of staying informed and educated about market trends and economic indicators. Understanding the factors that drive market movements can help investors make more informed decisions and avoid panic during downturns. They recommend regularly reading financial news, attending seminars, and consulting with financial advisors. Emotional discipline. Maintaining emotional discipline is another critical aspect of achieving peace of mind. Maluk and Robbins highlight the dangers of emotional investing, where decisions are driven by fear or greed rather than rational analysis. They advise investors to develop a clear investment plan and stick to it, even during turbulent times. This involves setting predefined rules for buying and selling investments and avoiding knee-jerk reactions to market fluctuations. Real-life examples from the book. Throughout the path, the authors share real-life examples to illustrate their points. One such example is the story of an investor who panicked during the 2008 financial crisis and sold all their stocks at a significant loss. This investor later regretted the decision as the market rebounded and reached new highs. This story highlights the importance of staying the course and not letting fear dictate investment decisions. Another example involves a couple who maintained a diversified portfolio and adhered to their long-term investment strategy despite market volatility. Over time, their disciplined approach paid off, and they were able to achieve their financial goals. This case study demonstrates the benefits of diversification and emotional discipline in navigating market turbulence. Maluk and Robbins' insights on market behavior and achieving peace of mind during volatility are invaluable for investors. By understanding the historical context of market movements, diversifying investments, staying informed, and maintaining emotional discipline, investors can navigate market volatility with confidence and work towards their financial goals. 4. What the financial services industry doesn't want you to know. The path reveals several critical insights about the financial services industry that are often hidden from the average investor. These insights are designed to empower individuals to make more informed decisions and avoid common pitfalls. Hidden fees and conflicts of interest. One of the primary issues Maluk and Robbins highlight is the prevalence of hidden fees and conflicts of interest within the financial services industry. Many financial advisors and firms operate on a commission-based model, which can lead to recommendations that are more beneficial to the advisor than the client. For example, an advisor might suggest a mutual fund with higher fees because they receive a commission, even if a lower-cost index fund would be a better option for the client. The importance of fiduciary duty. The authors stress the importance of working with a fiduciary advisor who is legally obligated to act in the best interests of their clients. Unlike commission-based advisors, fiduciaries are required to provide advice that is solely in the client's best interest, without any conflicts of interest. Maluk and Robbins provide examples of how fiduciary advisors can help clients achieve better outcomes by focusing on low-cost, high-quality investments and providing unbiased advice. Misleading performance metrics. Another critical point discussed in the book is the use of misleading performance metrics. Financial firms often highlight the performance of their best-performing funds to attract new clients, but these metrics can be cherry-picked and do not necessarily reflect the average performance of all their offerings. Maluk and Robbins advise investors to look beyond the marketing materials and examine the long-term performance and consistency of the funds they are considering. The dangers of market timing. Maluk and Robbins also caution against the dangers of market timing, a strategy where investors try to predict market movements and buy or sell accordingly. They argue that even professional investors struggle to time the market accurately, and attempting to do so can lead to significant losses. Instead, they advocate for a long-term, buy-and-hold strategy that focuses on consistent, disciplined investing. Real-life examples from the book. Throughout the path, the authors share real-life examples to illustrate these points. One such example involves an investor who was persuaded by their advisor to invest in a high-fee mutual fund. Over time, the investor realized that the fees were eroding their returns, and they switched to a low-cost index fund, which significantly improved their performance. Another example is the story of a couple who worked with a fiduciary advisor to develop a comprehensive financial plan. By focusing on low-cost investments and avoiding market timing, they were able to achieve their financial goals and retire comfortably. This story highlights the benefits of working with a fiduciary and following a disciplined investment strategy. Maluk and Robbins' insights into the financial services industry are invaluable for investors. By understanding the hidden fees, conflicts of interest, misleading performance metrics, and the dangers of market timing, investors can make more informed decisions and avoid common pitfalls. The key takeaway is to work with a fiduciary advisor, focus on low-cost investments, and maintain a long-term perspective. 5. How to select a financial advisor that puts your interests first. The Path provides detailed guidance on how to select a financial advisor who truly puts your interests first. This process involves understanding the different types of advisors, knowing what questions to ask, and recognizing the red flags that indicate potential conflicts of interest. Understanding different types of advisors. The first step in selecting a financial advisor is understanding the various types of advisors available. Maluk and Robbins explain that not all financial advisors are created equal. Some advisors are fiduciaries, meaning they are legally obligated to act in your best interest. Others operate on a commission-based model, which can create conflicts of interest. Fiduciary advisors. Fiduciary advisors are required to prioritize their clients' interests above their own. They typically charge a flat fee or a percentage of assets under management, which aligns their incentives with those of their clients. Maluk and Robbins emphasize the importance of working with a fiduciary advisor to ensure that you receive unbiased advice. Commission-based advisors. Commission-based advisors earn money by selling financial products, such as mutual funds or insurance policies. This model can lead to recommendations that are more beneficial to the advisor than to the client. The authors caution against working with advisors who are not transparent about their compensation structure. Key questions to ask. To determine whether an advisor is a good fit for you, Maluk and Robbins suggest asking the following key questions. 1. Are you a fiduciary? This is the most crucial question, as it determines whether the advisor is legally obligated to act in your best interest. 2. How are you compensated? Understanding the advisor's compensation structure helps you identify potential conflicts of interest. Look for advisors who charge a flat fee or a percentage of assets under management. 3. What services do you provide? Ensure that the advisor offers comprehensive financial planning services, including investment management, tax planning, estate planning, and retirement planning. 4. What is your investment philosophy? The advisor's investment philosophy should align with your own risk tolerance and financial goals. Look for advisors who advocate for diversification and long-term investing. 5. Can you provide references? Speaking with current or past clients can give you insight into the advisor's track record and client satisfaction. Recognizing red flags. Maluk and Robbins also highlight several red flags that indicate an advisor may not have your best interests at heart. Lack of transparency *. If an advisor is not forthcoming about their compensation or the fees associated with their recommendations, this is a major red flag. High-pressure sales tactics *. Advisors who pressure you to make quick decisions or invest in specific products may be more interested in earning commissions than in helping you achieve your financial goals. Limited product offerings *. Advisors who only offer a narrow range of products may not be providing the best options for your needs. Real-life examples from the book. Throughout the path, Maluk and Robbins share real-life examples to illustrate the importance of selecting the right advisor. One such example involves a couple who initially worked with a commission-based advisor. They were sold high-fee mutual funds that underperformed the market. After switching to a fiduciary advisor, they received unbiased advice and moved their investments into low-cost index funds, which significantly improved their returns. Another example is the story of an individual who was nearing retirement and needed a comprehensive financial plan. By working with a fiduciary advisor, they were able to develop a strategy that included tax-efficient investing, estate planning, and a diversified portfolio. This holistic approach helped them achieve their retirement goals and provided peace of mind. Selecting a financial advisor who puts your interests first is crucial for achieving financial security. By understanding the different types of advisors, asking the right questions, and recognizing red flags, you can find an advisor who will provide unbiased, comprehensive advice. Maluk and Robbins' insights and real-life examples in the path offer valuable guidance for making this important decision. 6. How to navigate, select, or reject the many types of investments available. The Path provide a comprehensive guide on how to navigate, select, or reject the many types of investments available. This process is crucial for building a diversified portfolio that aligns with your financial goals and risk tolerance. Understanding different types of investments. Maluk and Robbins categorize investments into several main types, each with its own characteristics, risks, and potential returns. Understanding these categories is the first step in making informed investment decisions. Stocks. Stocks represent ownership in a company. When you buy a stock, you become a shareholder and can benefit from the company's growth and profitability. Stocks are known for their potential for high returns, but they also come with higher volatility and risk. The authors emphasize the importance of investing in a diversified portfolio of stocks to mitigate risk. Bonds. Bonds are debt securities issued by governments or corporations. When you purchase a bond, you are essentially lending money to the issuer in exchange for periodic interest payments and the return of the bond's face value at maturity. Bonds are generally considered safer than stocks but offer lower returns. They can provide stability and income to an investment portfolio. Mutual funds and ETFs. Mutual funds and exchange-traded funds, ETFs, pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. These funds offer diversification and professional management, making them a popular choice for individual investors. Maluk and Robbins highlight the importance of choosing low-cost funds to maximize returns. Real estate. Real estate investments involve purchasing property to generate rental income or capital appreciation. This can include residential, commercial, or industrial properties. Real estate can provide a steady income stream and potential for long-term growth, but it also requires significant capital and management. Alternative investments. Alternative investments include assets such as commodities, hedge funds, private equity, and cryptocurrencies. These investments can offer diversification and potential for high returns but often come with higher risk and complexity. The authors advise caution and thorough research before investing in alternatives. Selecting the right investments. Maluk and Robbins provide a framework for selecting the right investments based on your financial goals, risk tolerance, and time horizon. Assessing risk tolerance. Understanding your risk tolerance is crucial for selecting appropriate investments. Risk tolerance is influenced by factors such as age, income, financial goals, and personal comfort with market fluctuations. The authors suggest using risk assessment tools or consulting with a financial advisor to determine your risk profile. Diversification. Diversification is a key principle in investment strategy. By spreading investments across different asset classes, sectors, and geographic regions, you can reduce the impact of any single investment's poor performance on your overall portfolio. Maluk and Robbins emphasize the importance of a well-diversified portfolio to manage risk and enhance returns. Long-term perspective. The authors advocate for a long-term investment perspective. They argue that trying to time the market or chase short-term gains can lead to poor investment decisions. Instead, they recommend focusing on long-term growth and staying disciplined during market fluctuations. Rejecting unsuitable investments. Maluk and Robbins also discuss the importance of rejecting investments that do not align with your financial goals or risk tolerance. This involves being wary of high-fee products, overly complex investments, and opportunities that seem too good to be true. Avoiding high fees. High fees can significantly erode investment returns over time. The authors advise investors to carefully review the fee structures of mutual funds, ETFs, and other investment products. Choosing low-cost options can help maximize returns. Steering clear of complexity. Complex investments can be difficult to understand and manage. Maluk and Robbins recommend sticking to investments that you fully understand and feel comfortable with. If an investment seems overly complicated, it may be best to avoid it. Real-life examples from the book. Throughout the path, the authors share real-life examples to illustrate their points. One example involves an investor who initially invested heavily in high-fee mutual funds recommended by a commission-based advisor. After realizing the impact of the fees on their returns, the investors switched to low-cost index funds, which significantly improved their performance. Another example is the story of a couple who diversified their portfolio by investing in a mix of stocks, bonds, and real estate. This diversified approach helped them achieve steady growth and income even during periods of market volatility. Navigating, selecting, or rejecting investments requires a thorough understanding of different asset classes, a clear assessment of your risk tolerance, and a commitment to diversification and long-term planning. By following the guidance provided by Maluk and Robbins in The Path, investors can make informed decisions that align with their financial goals and achieve greater financial security. 7. Success without fulfillment is the ultimate failure. Financial freedom is not only about money. The Path emphasized that true financial freedom goes beyond merely accumulating wealth. They argue that success without fulfillment is the ultimate failure, and achieving financial freedom should also encompass finding purpose, happiness, and meaning in life. The concept of fulfillment. Maluk and Robbins explain that fulfillment is about living a life that aligns with your values, passions, and purpose. It's about feeling satisfied and content with what you have achieved and how you are living your life. Financial success alone does not guarantee fulfillment. It is the combination of financial security and personal satisfaction that leads to a truly successful life. The role of financial freedom. Financial freedom is a critical component of fulfillment because it provides the resources and flexibility to pursue your passions and live according to your values. However, the authors stress that money should be viewed as a tool to enhance your life, not the ultimate goal. They encourage readers to use their financial resources to create experiences, build relationships, and contribute to causes they care about. Finding purpose and meaning. Maluk and Robbins highlight the importance of finding purpose and meaning in life. They suggest that individuals should reflect on what truly matters to them and what they want to achieve beyond financial success. This could involve pursuing a passion, helping others, or making a positive impact in the world. By aligning your financial goals with your personal values and purpose, you can achieve a more fulfilling and meaningful life. Real-life examples from the book. Throughout The Path, the authors share real-life examples to illustrate the concept of success with fulfillment. Example 1. The successful entrepreneur. One example involves a successful entrepreneur who built a thriving business and accumulated significant wealth. Despite his financial success, he felt unfulfilled and disconnected from his family and community. After reflecting on his values and priorities, he decided to sell his business and focus on philanthropic efforts and spending more time with his loved ones. This shift allowed him to find greater fulfillment and happiness. Example 2. The early retiree. Another example is the story of a couple who achieved financial independence and retired early. Initially, they focused solely on their financial goals, but after retiring, they realized that they needed a sense of purpose to feel truly fulfilled. They began volunteering and mentoring young entrepreneurs, which brought them immense satisfaction and a sense of contribution. This example underscores the importance of having meaningful activities and goals beyond financial success. Practical steps to achieve fulfillment. Maluk and Robbins provide practical steps to help readers achieve fulfillment alongside financial freedom. 1. Identify your values and passions. Reflect on what matters most to you and what activities bring you joy and satisfaction. This self-awareness is crucial for aligning your financial goals with your personal values. 2. Set meaningful goals. Establish goals that go beyond financial milestones. Consider what you want to achieve in terms of personal growth, relationships, and contributions to society. 3. Create a balanced life. Strive for a balance between work, family, and personal interests. Ensure that your pursuit of financial success does not come at the expense of your well-being and relationships. 4. Give back. Find ways to give back to your community or support causes you care about. Contributing to something larger than yourself can provide a deep sense of fulfillment. 5. Pursue lifelong learning *. Continuously seek opportunities for personal and professional growth. Lifelong learning can help you stay engaged and passionate about your pursuits. Maluk and Robbins' message in The Path is clear: financial freedom is not just about accumulating wealth but also about achieving fulfillment and living a meaningful life. By aligning your financial goals with your values and purpose, you can create a life that is both successful and fulfilling. The real-life examples in the book illustrate how individuals have found greater happiness and satisfaction by focusing on what truly matters to them. Thank you for listening. I hope this content is useful to you. If you like this kind of content, please like, share, and subscribe to our channel to support our team.